Hello, everyone. Good evening. This is Kevin with Real Traders Webinar. As always, we would like to thank you for taking a time out on your Thursday night to join us. And we'd also like to apologize for the mix up we had last week, the emails. We had some tech issues. And I know you guys ended up getting the emails later on at night. But we just want to thank you for showing up and thank you for understanding the mix up last week. So tonight we have a very special presenter. His name is Thomas Woods. He's a hedge fund manager. He's also the president of Superior Capital, LLC. He's the director of trading operations for MicroQuant. He's the host of MicroQuant Futures Live Trading Room, and he holds a degree in finance, economics, and marketing. So I'm going to pass it off to him if you guys want to hold your questions, and Thomas should take them at the end. Thomas, are you there?
All right, thanks, Kevin. Thank you all for having me. Just like Kevin said, if you have any questions, feel free to submit them at any time via the questions tab, and I will answer them as they come in, and then at the end we'll have a Q&A over everything as well. But as he said, my name is Thomas Wood. I'm the Director of Trading Operations at ValueCharts.com for MicroQuant. I'm also the President of Superior Capital, and thank you for having me tonight. We're going to be talking about using momentum and value for some high probability swing trade setups. These are just a couple of my favorite setups that we use, and these are setups that I trade on a daily basis in the trading room. So I'll show you two of my favorite setups basically for these swing trades. But before we get started, just a quick risk disclaimer. Trading or investing carries a high level of risk. It is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No presentation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. And then along those same lines, we're required to show you CFTC Rule 4.41, just a hypothetical disclaimer saying obviously screenshots and things are from the past, so it's easy to say that it worked here. However, these are setups that we trade on a daily basis with real money, so we do believe that they work, and we do use them. Now, before we dive in with examples and things, just want to make sure everyone can see my screen. You should be seeing CFTC Rule 4.41, now the 3 components of technical analysis. And I also want to make sure you can all hear me. So if you can just give me a quick Y or yes in the questions tab so I can know that you got it all. Excellent. Thank you. All right. So first things first, before placing any trade, we believe that there's 3 things you need to be analyzing. We call those the 3 components of technical analysis. And those make up what we call a good trade. So when you're placing a trade, you want to be looking at 3 things: price, momentum, and value. Now, traditionally speaking, you use price charts, which is just your typical open, high, low, close, or candlestick, to display the price component of the market. And then historically, people will be using moving averages or MACDs or a stochastic, or what I'll be using tonight is MQ momentum. These are what we use, different oscillators for displaying market momentum. And then lastly, now that we have value charts, we have a way to see objective market valuation. Now the reason objective, and the reason I underline that word, is because it's really easy for any analyst to go out there and tell you, okay, I believe a market's overvalued based on this, or it's undervalued based on that. Well, what we've done with value charts is we've come up with an algorithm that is based off of historical transaction data. So it goes off of where markets have actually traded. And it says, okay, based over the past X number of days or years or however long that you have it set for, this market typically will not trade that high. It's overvalued when it's up there. It's only trading up there about 2% of the time, or it's only trading down here about 2% of the time. So you have a higher probability, statistically speaking, of a market reversing. Now, what are value charts? What value charts do is they display price in one of 5 color-coded value zones ranging from this center green area here, which is fair value, and then above and below that we have moderately overvalued and moderately undervalued, which are the upper and lower yellow segments. And then above and below that we have significantly overvalued and significantly undervalued, which are the upper and lower red segments. Now, historically speaking, roughly 66% of all trading activity is going to take place in the fair value zone. Roughly 16% of all trading activity is going to take place in moderately over and moderately undervalued, so the upper and lower yellow zones. And then roughly 2.5% of all trading activity is going to take place in the significantly overvalued and significantly undervalued price zones, respectively. Now, what we have here, this is the value chart on Bloomberg. One thing you have to keep in mind is, depending on the platform that you are on, it's going to look a little bit different. So TradeStation just can't do the colors that Bloomberg can do, or NinjaTrader. NinjaTrader looks similar to Bloomberg. TradeStation multi-charts look a little bit different. They all are using the same algorithm to calculate the same thing. Now, tonight's in the examples I'm going to show you, I'm going to be using what we call value bars, which are the value chart, same thing as the value chart, except it's superimposing it over top of a traditional price chart. So it makes it easier to analyze both that price component of the market and the value component, so you can see both at once. It's going to paint the bar segments. Upper red corresponds to the significantly overvalued price level on the value chart. The upper yellow bar segments correspond to the upper yellow on the value chart. The green is the green. The lower yellow are moderately undervalued, and the lower red are significantly undervalued. Okay, so it's showing the exact same thing, except it's superimposing it on the price, so it makes it a little bit easier to see it. So if you have any questions throughout the day when you see these, if you don't understand what I'm talking about, over or undervalued, just let me know and I'll explain it in a little bit more detail. Now, the other indicator that we use with these setups is the MQ momentum indicator. Now, this looks and operates similar to an MACD. However, it's a little bit more reactive, and it uses a slightly different algorithm where you have a histogram displaying the spread between your fast indicator line and your slow indicator line. Okay, so fast line is the blue line, slow line is the yellow line. The histogram is displaying the spread. A negative histogram is a negative spread, so the fast line is below the slow line. A green histogram is a positive spread, so the fast line is above the slow line. Now, here's some rules that you're going to want to follow basically with any trading strategy you're going to use, but especially with the ones I'm going to talk about tonight. First thing, no matter what strategy I talk about with anyone, number one rule, always have proper stops. A good way to blow up your account is to not put a stop in there, especially if you're trading things like futures, where it's highly leveraged, or if you're trading Forex and you're using leverage, meaning you can use up to 50 times leverage. You want to make sure you have proper stop losses in place. That protects you. And whether it's a mental stop or a hard stop, doesn't matter. Just make sure you have that exit point so you don't lose control and just let a market run away from you. The other thing is, don't rush your trades. Let a trade come to you. If you go in every morning actively looking for a setup, so you say, I want to trade this market today in this direction, and you say, I'm going to go find the setup. Well, if there's not a setup there, a lot of times what traders end up doing is just inventing one. So they just come up with the idea, you know what, I'm going to get in now because this looks maybe good. Wait for it. Let the trade come to you. Wait for that really good. Wait for the gem setups, because that's going to increase the probability of your success. It's also going to increase your profitability and help decrease the number of losing trades you have. Third rule, have half profit targets and then leave the second half on to catch the runner. Now, I typically will do this on 90% of my trades. Sometimes if I have a long-term outlook of a market moving quite a bit further in one direction or the other, I'll take it, I'll leave it all on for the full swing. However, normally I'm going to have a half profit target. Now, the reason I do this is because if a market, let's say you're long from here, and this market goes up, and you're up, let's say $1,000 a contract, well, then this market reverses and comes all the way back down and stops you out. Well, if you had taken off half profit there, you at least locked in some gains. And then you leave the second half on there to catch that one runner, something like lean hogs, or like the indices, they've been going up for months here historically, over the past couple of years. This year they're kind of choppy. something like cattle or crude, where it runs up $10 a barrel. So you catch that runner. This also helps pay for that half profit target, helps pay for your losses, and then you're making your big money off of that those one or two trades that actually run. And then lastly, rule number 4, stick to the system. All right, no matter what strategy you're trading, if you're not going to follow the strategy, it's not going to work for you. I have a lot of traders that go out there and in my trading room, they'll trade something. They'll say, I'm losing money. And they'll ask, why am I losing money? You say, well, why did you get in that trade? And they say, well, I thought it was going to go this way. Well, did your strategy tell you it was going to go that way, or were you just guessing and trying to jump in because you wanted to trade? So make sure you're following, make sure you have a valid reason for entering and exiting all of your positions. And again, as I said before, you want to be analyzing the 3 components of the market before you place a trade. That's price, momentum, and value. If you leave out any one of those, you're missing out on a major part of the market. So here's the setup, the first setup that I trade. One of my favorites, these are divergences, both bullish and bearish. So what is a divergence? Divergence occurs when the price and the indicator are no longer correlated. So a bearish divergence happens when you have higher prices, so the market has gone up, but your indicator puts in a lower high. So prices are putting in a higher high, your indicator is a lower high. So it's a bearish divergence. A bullish divergence is the exact opposite. Prices put in a lower low, but your indicator puts in a higher low. Okay, so indicators going higher, markets going lower. That's a bullish divergence. Now, divergences happen in every market out there, and I've traded them in every market out there, including equities, futures, forex, etc. Any over-the-counter market, you're going to find divergences. And oftentimes, divergences are great ways of identifying turning points or when you're getting ready to go into consolidation. One thing to keep in mind is that a divergence doesn't necessarily mean that a market is completely reversing. It does normally mean or indicate that a market's getting ready to go into consolidation or potentially reverse. Okay, so you got to pay attention to what the market's telling you, pay attention to how the prices react when that divergence starts playing out. So here's an example just to explain what a bullish divergence looks like. This is RBOB futures contract on a daily price chart. This is your first low. This entire set of down bars, or this entire set of bars, that corresponds to this entire set of down or red histogram bars on your MQ momentum. So that's your low number 1. Low number 2 is this entire set of down histogram bars here. That corresponds to that set of down histogram bars or red histogram bars here on your MQ momentum. So you see you have higher lows on your momentum indicator histogram, higher lows on the indicator line, lower lows on price, and then you also have significantly undervalued prices. Remember, we said markets only trade significantly undervalued 2.5% of the time. This right here, the lower red bar segment, is significantly undervalued according to value charts. Now, when do you enter on a bullish divergence? You have 2 different options for entering. First, you enter on a significantly undervalued entry. So if you have the bullish divergence, you look at your momentum, you say, okay, we have a higher low momentum, prices are lower, and we're significantly undervalued. So you see that lower red? That gives you the okay to get in. Whoops. Sorry, not writing very well. Your second entry opportunity is when you break the previous bar's high. So that's entry 1. This is entry 2. All right, so you come down, you have, here's your high, this bar right here breaks the high, so you're getting long right there. And then you're holding it for the swing trade. You stay in it as long as momentum stays up, or you stay in it until you break the low of the previous 2 days. Okay, so this is all based off of daily price charts. Doesn't mean you can't use these strategies intraday, because you absolutely can. But you get out as soon as you break the low of the previous 2 days. So you're in either from there or from here. You're out as soon as you break the low of the previous 2 days. So either right here or right here. Now, if you're trading with the momentum and you're holding it as long as your momentum stays up, you are out on the same day up here. The very next day, you're going to be out of it right there. Out 2, out 1. All right, this is your half profit target. your half profit target is going to be the moderately overvalued price bar. So you're in it from undervalued, you're out 1/2 profit at moderately overvalued. Second half profit, break the previous 2 bars, or when momentum rolls back over. Make sense? Here's a bearish divergence explained. All right. First set of highs, so H1, high 1 is this entire set of up bars there, which corresponds to the entire set of green histogram bars here on your MQ momentum. High 2 is the second set here, corresponding to the second set there. Now keep in mind, you're looking at price, so higher highs, momentum, lower highs on the momentum indicator, and then value, overvalued, upper yellow bar segments. So when you have the divergence, you want to see it overvalued. So we're looking at price, momentum, and value. You're getting in on the break of the previous bar's low, right there. Here's 1/2 profit. And then you're out when momentum shifts back to the upside, which is right here. Or on the break of the previous 2 days' highs. Now, one thing you do want to watch, though, when this momentum starts picking up like that, you may get a bounce like this, but if you see that market bounce and then reverse and go straight back down again, that's oftentimes a bearish sign, especially with a market like RBOB. It's just a run on stops. RBOB does that a lot. So does markets like soybeans. Soybeans will run stops all the time. So keep that in mind. So let's look at a couple examples really quick of some bullish and bearish divergences in different markets, so equities, futures, and Forex. Here's a gold. This is a daily bearish divergence. So you see here, high number 1 corresponds to this entire set of highs there. High 1 corresponding to this entire set of highs here. Whoops. High 2. Or excuse me, high 1, and then high 2 is that set of highs there. High 2, and then high 2. You can see lower indicator line, lower histogram, higher prices. Remember your 2 potential entry opportunities? First entry is significantly overvalued. Right there is your first entry, that upper red bar segment right there. Second entry is the break of the previous bar's low, right there. First exit is the break of 2 bars ago's high. 1/2 profits off at undervalued. Your longer term profit target is the break of 2 bars ago's high, or when momentum rolls over to the upside, which is on the same day. Okay, so you're in it 1/2 and then full. Not a bad trade, lasts about 2 weeks, 3 weeks. In gold, nice swing trade to the downside. Now again, you can use these same setups intraday, and actually I would encourage you to use them intraday. What I do to lower my risk exposure when I place a trade, if I have a outlook, so for example gold, you have a bearish outlook because of the bearish divergence, but you don't want to be getting in at 60 and putting your stop all the way up at 85. So what you do is you drill down intraday and you find a short-term divergence on a 5-minute chart or on a 250 tick chart or on a 30-minute chart. You find a bearish divergence intraday where you can risk $200 or $300 a contract. And then once you start getting the money, you put a break-even stop in place and try to let it run. That's how you limit your risk and increase your reward-risk ratio. For all of my trades, I want to have a reward-risk ratio of a minimum 2-to-1. Typically, I'll have half profit off at a 2-to-1 reward-risk ratio, because what that does is if you take off half at 2-to-1, that means you paid for the entire risk of the trade with only taking off half profit, and then you make the money on the runner. Okay, so if I risked, let's say I was trading 2 contracts of gold, I risked $100 a contract, so we have $200 risk. I'll take off 1/2 profit, so take off 1 contract at plus 200. That's a 2-to-1 reward risk ratio. So you just paid for your entire risk with the half profit, and then the runner that caught the $100 move ended up making 10 grand. Okay, makes sense? So let's take another look at Apple. Here's an equity with a very nice bearish divergence. This was the absolute high in Apple. So you had higher prices, lower momentum, overvalued and significantly overvalued prices. Now, one thing you do want to look at, you see here, this is why you don't ever want to just take one component of the price. You don't ever want to just look at value and say, okay, significantly overvalued, I'm going to sell it, or significantly undervalued, I'm going to buy it. You always want to look at the 3 components of price or of the market. So price, momentum, and value. Here you are significantly overvalued, but look at how strong this momentum is. This momentum is just steadily increasing. No way in the world would you want to be shorting that. Over here, prices are still climbing and you're significantly overvalued. Momentum is still increasing, although it is weaker. But right at the high, one thing you'll see is what we call an evening star. An evening star is a candlestick reversal pattern where you have an up bar followed by a gap higher with a doji and then a gap lower with a down bar. Okay, an evening star is a price component of the market, so you're going off of the price, and then you're also looking at your momentum with the bearish divergence, and then you're also looking at the value. You were significantly overvalued, so you have the entry on the break of the previous bar's low. Right there, you're in it short. Sell 1. Your exit is either the break of 2 bars that goes high. First half profit is off at undervalued. Second half is either off at the break of 2 bars that goes high or when momentum shifts all the way down here. So you're either going from there to there or from there to there. Not a bad trade either way, especially for a trade where you have a reward risk ratio of 10, 15, 20 to 1 because your stop is going above the previous high. Here is another example. This is for Forex. This is the euro dollar on a daily price chart. We have a bullish divergence as well as a bearish divergence. So you can see here, we're looking at price, momentum, and value. Again, here's low number 1, low number 1 there. By the way, this is also a bullish divergence. This set of lows compared to this set of lows, this is actually a double bullish divergence. So low 1, low 2, low 3. Momentum higher every time. This is your first move up. Here's your first low, and then here's your double bullish where you have low number 4 higher than low number 3. So low number 4, your momentum L3, L4, higher momentum, lower prices, moderately undervalued. I don't know if you can really see it. But the very bottom portion of this price bar is lower yellow, which is moderately undervalued. Okay, when you see a market that barely touches into under or overvalued, when it barely touches into under or overvalued, and then immediately pulls back down, a lot of times that is a very good entry. I.e., for example, right here, barely poked up overvalued, immediately pulled back down. Barely poked up overvalued, immediately pulled back down. Barely poked down undervalued, immediately pulled back up. But what we're looking at is the divergence. So you had higher price, equally low prices, moderately undervalued, higher low momentum. Market ends up reversing. You're either in it from undervalued, in it from the break of the previous bar's high, then you're out on half profit at overvalued, which happened on the same day, or significantly overvalued the next day, or the break of 2 bars that goes low, or when momentum rolls over to the downside, which is right there. So either way, not a bad trade from there to there or from there to there. Now, a bearish divergence happened right after this. You can see we have lower momentum highs. So here's your high 1, high 1, high 2, corresponding to high 1 and then high 2. You can see significantly overvalued. So there's your first entry. Second entry is on the break of the low. Enter 1, enter 2. First exit is moderately undervalued. Exit 1. Second exit is break the previous 2 bars highs, so either there or down here, or when momentum rolls over to the upside. Now, another thing to watch for here is this is another momentum trade. Now, this is just a bonus because this isn't really the topic for tonight. But what this happened right here, where you had one green histogram bar up with red on either side. Same thing right over here, one green histogram bar up on your MQ momentum. We call this a one green finger, okay? It's a very bearish pattern. Same thing goes for one red finger, where you have one red histogram bar down and then green on either side. So that's a reversal pattern as well. So you're in on the break of the previous bar's low. This indicator is generating this bar as it's developing. Okay, so this will move up and down as it's developing. As soon as the bar closes, this bar ends. But typically, you'll be able to, once you get the hang of understanding how markets move, because each market moves differently, you'll be able to tell when a market is forming the divergence, when it's slowing down or peaking out, or when you get something like this, a shooting star, or when you're significantly overvalued, to know that the divergence is going to play out. Am I using value charts? What I'm using here is value bars. It's showing the exact same thing as value charts. I just used value bars instead of value charts because value charts would have made it a little bit more cluttered on the screen for the example, so I wanted to make it a little clearer to see the price action. But value charts and value bars show the exact same thing. They're both doing the same algorithms, just one's painting it on top of the price bars, one is painting it on an indicator itself. How can it be undervalued when it is above the moving average? I'm not sure what you mean. It has nothing to do with moving average. What's technical mathematical definition you're using to define over and undervalued? It is a proprietary algorithm that's patented, so we can't really get into details on it. But what it does is it calculates based on dynamic volatility units. So you have a standard deviation, you have your center line, then you have 1 and 2 standard deviations above and below this center moving average, and these expand and contract. The DVUs do expand and contract based on volatility. So as the market becomes more choppy, the levels, moderately overvalued and then significantly overvalued above that, are going to get further apart or narrower depending on the volatility. When I'm explaining the entries and exits, are these actual trades, or am I explaining how it would be traded based on the indicators? Both. Gold, for example, we traded. Apple, I didn't trade, although we did broadcast it. The euro dollar here, I didn't trade. I'll show you some other examples that I did trade here a little bit later on. But some I traded, most of the futures ones I traded. The Forex and equities ones, not necessarily, because I trade the futures trading room. All right, so let's go ahead and take a look. We have another strategy, step number 2, which are bull and bear flags that I want to cover. Try to get through these as soon as I can because we have only a little less than 30 minutes left, but it's a lot to talk about. All right, now what is a bull and a bear flag? Bear flag pattern is a bearish continuation pattern. If you've ever been in the futures trading room for value charts, you know I call it a golf club a lot of times. The reason being, it looks similar to a golf club, where a golf club has a handle and then the club face, club head, and then continuation to the downside. So this is what a bearish bear flag looks like. It's a down move followed by 1 to 4 higher lows. So move with a move back into fair value or even overvalued from undervalued, and then a break of the previous bar's low with strong momentum surge to the downside. So you're looking for a down move, kind of market kind of takes a breather, and then continuation lower. A bull flag is a bullish continuation, basically the same thing, just flip it on its head. So it's an up move followed by 1 to 4 lower highs, move back into fair value or even undervalued, and then a break of the previous bar's high followed by strong momentum for a continuation to the upside. Now here's an example of just a textbook bear flag in gold, and we actually traded this. We also traded the trend line that was right here. Went up and across those lows in gold. Gold broke that trend line, came back, retested on the tick, and then just fell to the floor. We were short the heck out of that in the trading room both those days. Worked out really well. So here is your bear flag. So you have your down move followed by 1 to 4 higher lows. So there's a higher low, here's a higher low, and there's a higher low, followed by a break of the previous bar's low. You enter on the break of the previous bar's low. So right here, you have a break of the previous bar's low. You're getting short. Your stop would be above the high. Now, again, I would never tell somebody to take a highly leveraged instrument like gold or something else and put your stop $2,000 or $3,000 a contract away. That's too much in my opinion. Typically, I risk about $100 to $200 a contract on every trade. So you go down intraday and you find an intraday overvalued bounce, or you find a bearish divergence or an intraday golf club, something you can get in with a much less risk, and then you try to ride it out for longer term. So you have the down move. You want to see the market close down. So you see we came down, closed down, and then you want to see the follow through on strong momentum. So you see our momentum just took off to the downside here. So huge down move of momentum, nice follow through off of the bear flag. So again, it's a significant down move. Just to reiterate, significant down move, significantly undervalued, followed by a bounce back into fair value, followed by a break of the previous bar's low, and then a significant strong surge of momentum to the downside in the direction of your golf club or bear flag. Make sense? So again, you're looking at price, momentum, and value, because this is what's going to help you find these high quality, high probability trades. Let's go ahead and take another look at a bull flag. And I apologize, for some reason value bars, I don't have them on this example. I meant to change that, but must have forgotten. You want to have a pullback into fair value. So here, this actually did pull back into fair value, but this is Amazon on a daily price chart. A bull flag, remember, is a strong up move. So here's your up move, followed by lower highs. So there's a lower high there compared to that high. So lower highs, and then a break of the previous bar's high right there. So you're long on the break. And then followed by a strong surge in upside momentum. Okay, so we want to have it pull up, big up move, back into fair value, break the previous bar's high, followed by a strong surge in momentum. Your exits for this can be the same way as you would have traded for the bullish and bearish divergences. So you're enter on the low, 1/2 profit off at undervalued, full profit off on the break of 2 hours ago's high, or on the shift of momentum. Either one. You still are on this example for gold, you made $150 an ounce in 2 days. So not bad. So let's take a look at a couple of examples of what this actually looks like in the markets. So here's gold. Here's very recently. So remember, we had that bearish divergence we were talking about here. And this is another thing that's really good about bull and bear flags. One of the reasons I like them so much. If you think you've missed a move, a lot of times the market, right after a move starts, is going to give you that entry. It's going to give you the continuation, the bear flag or the bull flag to jump in. So even if you didn't get in from your original 2 entries, remember the bearish divergence entries were there and there. If you missed those and you're going, oh no, I missed the entire gold move, not necessarily. Watch what the price is telling you. So you see here, big down move, followed by a higher low in price, followed by a break of the previous bar's low. So big down move, pulled back into fair value, which is the green price bar, break of the previous bar's low, and then continuation to the downside out on the break of 2 days ago's high, or when momentum rolls over. Either one worked out really well here for gold. You caught half of that entire move. In your risk, you had another reward risk ratio of 10 to 1. Here's an example of a bull flag. So you see gold taking off way back here, which gold came up off of a bullish divergence, low 1, low 2, nice bullish divergence. You go, oh no, I missed the bullish divergence. Well, not necessarily. Here's a bull flag right here. Big up move, pull back into fair value, break the high, and run. Here's another nice bull flag here. Big up move, pull back into fair value, break the high, and run. You want to see the surge of momentum when it breaks the high. Again, surge of momentum when it breaks the high. Both of those great entry opportunities to catch the rest of the up move. You're either out when momentum rolls over, or when you have the bearish divergence, or when you hit overvalued or significantly overvalued. Lots of different ways you can determine your exits. Either way, they all worked out really well for both bull and bear flags. And again, all you're looking at is the price, the momentum, and the value. Here's another example for Apple. This is on a weekly chart. You had, this was your evening star. So let's say you missed that evening star all the way up at the high. You missed the bearish divergence. You're going, oh no, can't get an Apple. That's not true. You had several great opportunities to trade Apple short. So big down move followed by a pullback into fair value, break of the previous bar's low, and then surge, 1/2 profit, full profit when momentum rolls back over all the way down there. Again, big down move, pull back into fair value. So here's your higher lows, several higher lows in a row, pull back into fair value. So you have the green price bar. And this is another thing to watch for here. This is what we call an underwater doji. An underwater doji is a fair value doji. So you have a doji pattern in fair value, but you look at your momentum. Momentum is still red. So you have an underwater doji. And then you have a break the previous bar's low, big move to the downside. Enter on the break of the low. Here's another example. Big down move, another higher low, back into fair value. That bar's green. Break the previous bar's low, another surge lower, pull back into fair value or even overvalued. Remember, you can even pull up all the way up into overvalued, break the previous bar's low, and then surge to the downside. Then you had a bullish divergence down here where you had higher momentum lows with lower prices, significantly undervalued. There's your long entry. Here's your 1/2 profit at overvalued. And then you actually had a shooting star, what we call a golden shooting star right there for reversal back to the downside. So where does your stop go for the Apple example? Good question. When you trade the golf club, your stop goes above the broken lows high. So here, when you broke the low here, so you broke the low of this bar, your stop goes above that bar's high. Now, again, I wouldn't recommend putting your stop that far away, especially if you're trading off of a weekly chart or daily chart. So what do? You drill down intraday, and you find a bounce overvalued intraday where you can risk $200, where you find a bearish divergence intraday on a 5-minute chart or a 250-tick chart, where you find it on a 30-minute chart, something where you can go short-term with less risk. Your stop is always above a previous higher low because that higher low provides support or resistance. All right, so it gives you like a shield between where prices are and where your stop is before it gets you out. How do you use the cycle finder indicator? All right, cycle finder is what we had right here. What you can do is you can use cycle finder to time your entries. So green bars like this are an up cycle. Red bar is a down cycle. So if you're looking to go short on a bearish divergence, you're going to get short on the down cycle. That down cycle corresponds to this bar right there. So you go short on that bar's close, which also would have been short on the break of the low. So cycle finder, you can also use it for divergences. Red bars mean down cycle, green bars mean up cycle. It helps you with timing. All right, so let's take another look at one more example really quick for the euro dollar for bull and bear flags. First off, over here on the left, remember your divergences. High number 1, high 1, high number 2, high number 2, 1, 2, H1, H2, significantly overvalued. So there's your entry. Entry 1, break of the low is entry 2. Exit 1 is moderately undervalued. Exit 1, exit 2 is break of 2 bars, it goes high, or a move back into fair value, or back into upside momentum, which is right here. Either way, worked out really well, either from there or here down to there. So not a bad trade for the bearish divergence. And then you come down here. Here's your bull flag. So you had a strong up move, followed by a pullback to fair value with a lower high. So here's your first high on the price. Here's your second high. And then the break the previous bar's high. So you want to see it again pull all the way back into fair value or even in the undervalued. You want to see it break the previous bar's high, followed by a strong surge momentum. Another thing you want to be looking at when you're looking at the momentum indicator, a bull flag is stronger if it stays green. just like a bear flag is stronger if it stays red. Okay, so a great example of this is the Apple bear flags we had here. You see how our momentum stayed red for all these bear flags? That makes that setup that much better. Okay, just like for the bull flag, when it stays green, big up move, pull back into fair value, break the previous bar's high, and then run. That makes that setup that much better. And then here's another bear flag, by the way. Down move, pull back to fair value, break the low, run. So make sure you pay attention. Once again, I'm repeating it as you'll probably have noticed throughout the day. Price, momentum, and value. All three of those are what are giving us all these setups that we're talking about. So here's another example of a second bull flag. Strong up move all the way up into overvalued. Pull back into fair value, the green. So pull back all the way back into the green. Break the previous bar's high, run. Here's your half profit target. Your second profit target ended up being basically break even stop. Okay, same thing here. Big down move, pull back into fair value, and then continue on lower. Half profit target there. Second profit target, basically break even. This is why I like taking off half profit. Now, remember I said with your bull and your bear flags, the bar that breaks, so the bar that breaks the previous bar's high. So this one right here. See how this closed up? You enter as soon as it breaks the high, but you watch that bar until it's closed, because if it does not close up, then you may have a problem. Just like with the bear flag, you enter as soon as it breaks, but if it does not close down, you may have a problem. Here was an example of a failed bull flag. This was here just recently. Euro rallied, had a pull back into fair value, all the way down to undervalued actually. You had what we call a no return, where you went undervalued with no downside momentum, so momentum stayed green even though you were undervalued. You broke the previous bar's high. We wanted to see this run. Instead, this came all the way back down and closed just like this. And then the next day, we actually broke the low. I thought we had a bear flag, but then it just closed back its fair value again. So you want to watch that bar when it breaks the low or breaks the high. It needs to either close up for a bull flag or close down for a bear flag. You don't want to see it closing in a doji pattern or in a neutral spinning top. Make sense? Will there be recording for tonight? Yes, I believe this is being recorded. So those are the setups. Again, all of them are analyzing price, momentum, and value. If you're interested in using the value charts indicator, value charts are displaying the exact same thing that these value bars are showing, except they're on an indicator down here. We have a special for tonight. We're only selling it to 100 people tonight, and that is $97 for the indicator. That's just for the value charts indicator. Normally we charge $9.97. You can't get it unless you buy the bundle, but we're selling it. We're piecing it out tonight for the first 100 people. After that, no guarantees. I was told we're only doing it for 100. Normally that sells out really fast. So $97 for the value charts indicator. You can go to valuecharts.com/chart, and that'll get you that indicator so you can be analyzing price, momentum, and value. Because without all three components, momentum and value, you're missing out on a major part of the market that you need to be looking at when you're trading. Does this include the momentum indicator as well? No, this is just for the value charts indicator. We will, for those of you that do buy the value charts indicator, I believe we're also going to be doing a special here later on for the entire bundle. It's going to be like 50% off or something. So if you do want that. Does it work on Sierra and Toss? Yes, it's on. Give me a second. My mind is drawing a blank here. We're on Bloomberg, TradeStation, Sierra, so Infinity, Toss. We're on multi-charts, eSignal. So NinjaTrader, eSignal, Sierra, TradeStation, Toss, Bloomberg, etc. Basically everything out there are most of the major players. There's a couple we're missing, but most of them have it. Does it work on lower time frames? Yeah, all these setups that we talked about tonight work on any time frame, and I would encourage you to actually go through when you place the trades. Like I said, these are off of, you get your setup So you get your outlook. Okay, I think this market longer term over the next several days should go down based on this. Then you drill down intraday to a 30-minute chart or a 10-minute chart. And then you place a trade there because you have lower risk because your stop goes above the high. Unsolicited comment, you bought this and it does work as described. I'm glad to hear it, Bob. What about the value bars and momentum indicator? They're in the larger bundle. The value bars indicator displays the same thing as value charts. We do offer a 30-day money-back guarantee. So if you have any problems with it after 30 days or within 30 days, no questions asked, you can get your money back. What time frame is that? It works on any time frame you want. I always go through, look at my dailies and my weeklies, look at the setup on the dailies and weeklies, then drill down intraday and place the trade. Does value bar show the same pattern on shorter time frames like 5 and 10-minute charts? Yep, absolutely. It works on any time frame you want. Keep in mind, value is time dependent. That's what's great about this. So if you have a 5-minute bar, you could have a 5-minute undervalued bar with a daily overvalued bar. Okay, it's time dependent. So short term, the market may be undervalued. Long term, it could be overvalued. That's why you drill down and you find the short term entry so you can have less risk. Does it work on lower time frames? Yes, it works on lower time frames.
Hey, Thomas, sorry to jump in.
Value charts are included with this.
Just to let everybody know, I put the link over there in the chat box, so if anybody needs it, it's right there.
Yeah, Real Traders,
realtraderswebinar.com/value charts.
Yep, thank you, Kevin. realtraderswebinar.com/value charts. You can get this deal. Arthur, I'll take a look at crude oil here in just a moment. Value is more volume dependent than time dependent. Not off of the way the value charts indicator works, it does not go off of volume. So it's not analyzing volume, it's analyzing price action. Value charts work with Sierra Charts, TradeStation, Ninja, and Toss on one purchase. No, you can buy it for one platform, and then it's an additional few bucks for each platform that you want it to add it on. Because we have to have a developer go in and do it, so you just got to pay for their time. How much drawdown do I tolerate? I only risk between $100 to $200 per contract per trade. One time. It's one time. It's not a monthly fee. I don't trade options that much, Sanjay. So David Kino in the options trading room at Value Charts, he trades options a lot. So he pays attention to Greeks. I personally don't because I trade futures. There are no Greeks. The more volume in an area, the more it becomes a value area. That's a true statement if you're analyzing volume, but value charts are analyzing something completely different. All right, so that's basically it. Again, the link, Kevin posted it in there for you in the chat box, realtraderswebinar.com/value charts. That way you can get access to the indicator, $97, limited time offer, only for the first 100 people tonight. And once it's done, that's it. 100 people, and then it goes back to full price, which is $9.97. So I hope you enjoyed it. Does it work on tick and range charts on Ninja? That's actually a really good question. It works on tick charts, will not work on range charts. Remember I told you value charts, it was based on the dynamic volatility units. Range charts remove the volatility from a bar, or it removes volatility from the market. So there's no volatility component, which means the DVUs cannot adjust to the market, which means it does not work for range charts. So you can't use it on range bars, but you can use it on tick charts. I use it on tick charts for every market I look at. I look at 1,000 tick and 500 tick for all the markets. No, it's not on MetaTrader at the moment. You are welcome, Haley. Does it come with MQ Momentum? No, it doesn't come with MQ Momentum, although I do believe for those of you that do buy this, that do buy the value charts indicator for the $97 deal, I believe there's another deal that you can get for the MQ Momentum indicator. How do you trade gap ups at the open? It depends. Depends on what the gap's based off of. Yes, it's on TradeStation. TradeStation is who I use TradeStation. That's who my broker is. So I trade on TradeStation. Yeah, you can use a 310 oscillator or an MACD for the momentum. That is very true. Like I said, for analyze momentum, price charts, you're looking at candlestick charts. Remember 3 components of price or of the market: price, momentum, and value. Candlesticks, open, high, low, close, etc. Momentum, you're looking at MACD, stochastic, etc. Or MQ momentum is what I use. And then for value, you're looking at value charts or value bars. I look at all 3 of those no matter what market I'm trading, no matter what time frame I'm trading off of. Medvest, send an email into support@valuecharts.com. I'm not 100% sure what the additional cost is for each additional platform. I believe it's just a few dollars more to get it for your other platforms once you've bought it. Yeah, you can use a 250 tick chart for trading the Dow. I do prefer using about a 500 tick chart for the Dow, but a 250 is fine. There are, if you go to YouTube, there's a lot of, just Google how to use value charts. There's a lot of different videos and things out there of recorded webinars. Plus, Kevin's got a recording of this webinar, tonight's webinar, that you'll be able to get access to. I believe he said he's going to send that out, put that up on their YouTube channel. The link is realtraderswebinar.com/value charts. You get the value charts indicator. That's this indicator right here. All right. Value charts. Is this right here, this bottom indicator, displaying the 5 price zones, the 5 value zones. Remember, value bars shows the exact same thing. It just puts it on top of the price chart. Value charts, this right here, is the actual indicator itself and actually shows you the DVUs, ranging from 0 to positive 12 and 0 to negative 12. Those are what adjust based on volatility. Yeah, there will be a recording sent out to everybody. All right, that's it for me. I hope everyone enjoyed it. Again, realtraderswebinar.com/value charts. For the indicator, if you want the value charts indicator, it's only $97 for the first 100 people. If you have any questions, feel free to email support@valuecharts.com. I would be more than happy to help you out. Oh yeah, Arthur, let me take a look at crude oil really quick. Sorry, said I would do that, so let me do it really quick. Pull up crude oil. You were talking about your dailies. Let me see what you were saying. It looks like it could be forming a golf club. Remember the golf club pattern? So you have a down move followed by a higher low, and if it breaks today's low tomorrow, it should move lower, at least down to this trend line. So down move, pull back. We're in fair value now. Now we need to see a break of the previous daily low. I would actually like to see tomorrow just kind of stall out like this and then break lower. But we will have to keep an eye on it. That's why you wait until it breaks the low. Again, hope everyone enjoyed it. Kevin, you want to go ahead and take back over?
Sure. Thank you
for having me. I appreciate it.
Thank you, Thomas. Thank you so much for such a great presentation. And again, everyone, just let you know, if you want to check out Thomas's offer, you can go to realtraderswebinar.com/value charts. And yes, we will get the recording wrapped up, hopefully within the next 24 to 48 hours, as we usually do. And as always, we just want to thank Thomas and all of you for showing up tonight, spending your Thursday night with us. Next Thursday, we'll have another weekly hangout, and we look forward to seeing you there. Thank you so much, guys. Thank you, Thomas. Everyone, have a great night. Yo,
Yeah. You see, I told you. See?
You have to listen to me, man. I know the suckers in this industry. See, man.
no, I mean, dude, but I made a big deal
I've
about the
been
link.
approaching those guys for 20 years, man. I know who are the fuckers.
I made a big deal about the link. Even we went back and forth, back and forth. Pat was like, "Oh, why?"
And even when he realized he was wrong, he kept on showing the fucking slide with their phone number and his link.
Yeah, but at that point, as long as they knew, like people will always click the link. You know what I mean? They're always gonna click the link. They're lazy.
No, but some people don't even find it.